All right. Thanks for joining us, everybody. Today we are chatting. We're going to go through kind of the top 10 home buyers tools, things that can help you either get into a home, minimize your costs, create reassurance. So we're just going to kind of go through each item, give a brief description with our co-host Chase Hodgson on the lending side, and talk through in general, because everybody's situation could be slightly different, but which ones do we feel like that would be the most advantageous? So when you're looking at purchasing a home, you'll have these kind of tools, front of mind, top of mind to help you look into what your options are in home buying. Obviously, you can reach out to us, and we'd be glad to share how this is going to specifically help you in your situation. So, with that, let's bring on our co-host Chase. Are you ready to rapid fire this today, Chase?
Yeah, let's do it, man. Let's do it. Good topic.
Yeah, you see these top tens or whatever, and it just occurred to me. Sometimes I agree with them, meaning are they helpful or are they not? My hope is we can give a quick description because some have been around for a long time, some are relatively new, some people are familiar with them, some people are not, and then kind of they don't necessarily want to know the details, but they want to know if they're helpful or not. So,
Right.
as for the general audience of a general home buyer, is this helpful to them or not? So yeah, really excited to bounce into this. So cool. Well, let me do some real quick housekeeping items here. For those of
Okay.
you that I haven't met, my name is Jerod Lee. I'm the associate broker and team lead here at My Home Connection, also known as MHC Realty. Our sponsor for today is the perfect home buying process. We've now gone over 20 years of developing this process, now in part with Chase, to help bring some promotion to you in the way of up to $500 on the appraisal side that the Chase will help with, and then up to $500 on the home inspection that will contribute at closing, and then just a myriad of other tools to help you feel more comfortable in your buying process, from reports and maps, and we've got great podcast series we'll send out to you, a very educational, very informative. We like to share some secrets so that as you're looking around kind of what the ins and outs are and what's going on behind the curtain. So feel free to reach out to us if you want to take advantage of that no obligation consultation. We'd be glad to help. So, Chase, we chatted just briefly here before the episode,
Mhm.
kind of what they are. This is not all inclusive. It's a subset, but we're trying to hit the biggies, of which I think the most timely right now is the seller concession. Not only because what they're doing with it these days is slightly different, but also the tremendous help it can be for buyers. Can you briefly describe on the lending side kind of what a seller concession is?
Yeah, so seller concession is just depending on the type of loan, the seller is allowed to contribute a certain percentage, and that percentage varies depending on the type of the loan, right? Typically from 3 to 6%. That's the range. And allows them to contribute towards. You can't use it towards down payment, but you can use it towards closing costs. You can use it towards interest rate buy down. Um, and it basically just makes it easier, right? And less money out of pocket for you.
Okay, so just for the audience here, rough math. If your loan allows you to get 3% from the seller, 3%, $3,000 for every $100,000 purchased, which is not insignificant, right? On a kind of a $500,000 home,
No.
that can be super helpful. And we're going to talk about those seller concessions because they lead into the other tools.
Mhm.
These are concessions that the seller is giving to you, whether it's a existing home buyer, seller, excuse me, what we call resell, or a builder. So you can apply these monies for what, credit, for lack of a better term. These
Yeah, it really is. If you think of an accounting balance sheet, right? You've got your debits and your credits when you're going through your closing costs, right? What you're paying for, what the seller's paying for, because there are those, right? There are those items in every transaction. Some things the seller pays for, some things the majority of it the buyer pays for, right? So those things add up quickly. Seller concessions can either be used to reduce that amount that you have to cover in closing costs, or it can be used as a permanent or a temporary buy down.
Excellent, excellent.
will
So
help
yeah, let's get
reduce
into
their
the
monthly
specifics of
payment.
how they can use those credits later. But let's talk about the tool that some people can take advantage of, and actually more than I think people buyers than are aware. There's other 100% financing loans. I think most people's reaction is VA. But anyway, I'll let you describe that and the other loans and kind of how that's best leveraged.
Yeah, so 100% down. The you know obviously a lot of you think a lot of VA, right? The veterans using their benefits, right? And they move around. They tend to move around a lot, and so right, if every 4 years they bought a new house and they're money coming out of pocket for down payment, that becomes difficult for them, right? So
Hmm.
100% down loan can be really good for them in those situations. We also have what are called USDA loans. Uh, Basically, you think of them as urban development, right? So you don't qualify everywhere, but in the more rural areas where they're trying to push populations out of high concentration into some of these areas, they will offer 100% loans as well. And and quite honestly, depending on where you're at, again in Idaho, we're so lucky. It's not 100%, but the way that Idaho housing works these days, you can get in with as little as $500 now.
Yeah, yeah, that's a beautiful segue into the down payment assistance here. But let me back up. There was a comment I was going to make on seller concession that I think is super important. The catch here is the market leaning towards a buyer's market or a seller's market or somewhere in between, right? If you're going to get these sellers concessions from people selling you the home, if the market is strong and there's no reason for them to give you a credit, those aren't going to be available as the market strengthens up in the seller's favor. So I just wanted to caveat that we can't always go out and ask for money for closing costs or interest rate buy down, those things.
Yeah, well, technically you can always go out and ask. It
Well,
doesn't
we can
mean you
ask.
always get it right.
Yeah.
And I mean, there's other ways to do it, but again, it depends on the market and the conditions, right? Because you can
Yeah.
offer above asking, right? In a more heightened market, you can offer above asking and then request a seller credit. But the caveat then is the house worth that, and will it appraise for that? Because if it doesn't, then that credit goes away.
Yeah, and that's a tough thing to accomplish because likelihood is the listing agents priced it, at or near the
At the
top of
top,
the market to
right?
get the homeowner the equity out that they can. So anyway, there's some things to consider there, but I just want everybody to know that that's a shifting tool that may or may not exist. Yes, you can go ask at any time, but that doesn't mean a seller has to agree to it.
Right.
So we started shifting towards down payment, right? You have USDA, you have VA on the 100%, but talk us through specifically here in Idaho um, the option of getting assistance in your down.
Yeah. So I'm not licensed in all 50 states, but I don't know, 16 or 17, and everybody has some kind of what they call a bond agency, right? It's a quasi governmental agency that gets funds to help people to help home purchases, right? And so they have down payment assistance programs available. Of the ones that I'm licensed in, Idaho is by far the best. The closest one that I've seen is Washington, um, and it's still nowhere near as good as what we offer here. And so basically, the down payment assistance works. You have your first loan, which is the majority of the loan, and then they will give you a loan in second position to cover your down payment assistance, right? And that can be a forgivable loan over so many years; it just goes away. Most often, we see it as it's a loan that's much smaller with a higher interest rate that's amortized over a shorter period of time, right? So it may add, $50 to $200 a month to your home payment, but it helps you cover that down payment assistance. And with changes that they've made recently, um, between seller credits and down payment assistance that they offer, you can literally get in with as little as $500 down.
So you're buying a
Now,
$500,000 house, all things align, you're under $1,000, $500 to even get into the property with all of these tools.
right? Yeah, the biggest caveat for them now is you have to make $170,000 a year or less. Like that's
Less.
where there's that income cap there. And then
Yeah.
with once you're under that, then there's different programs based on income, you know, FICO, all that stuff. They offer all the normal programs, the conventional FHA, USDA. They offer all those programs within their programs. So you have all the normal loans that just have their down payment assistance with them.
So let's give the folks a little bit more detail on this because I want it to settle in. You're getting a first, kind of a normal. I mean, I hate to say normal in our industry at all, but you know what I mean. You're buying the
Yeah,
home with the first loan, and instead
so,
of
so
coming to the table with the full down, this bond agency is giving you a second loan for a reduced period of time, reduced term, less probably than the 30-year, probably like a 10-year, at a higher rate that you're going to pay both mortgages, but you're likely going to pay off the second faster. One
yeah,
because of
yeah.
term, but anyway, it's just to help
So
you for those that don't have out of pocket.
yeah, so if you figure an FHA loan, right? You have to for an FHA loan, yeah, minimum is 3.5% down, right? So minus the 3.5%, that's your first loan, right?
Hmm.
The lien and the loan in first position. In
Yep.
second position would be that 3.5%, just for simplicity, right? There's some
Hmm.
caveats around that. So, and that is so if your, I think their FHA interest rates are like at 5.75 right
Hmm.
now. So that's the other plus about them. There's not a big hit on interest rate for using their programs, which is typically the
Hmm.
case, and why I say we're better than Washington, because their FHA rates, conventional rates, they're competitive with everybody in the valley where they're at,
Hmm.
even with the down payment assistance. Whereas if you use everybody else's down payment assistance, it usually jacks your interest rate up quite a bit.
Yeah.
So anyway, so you have your first, right, that covers the 96.5% of the loan. Then you have a payment with that. Then you have your second, which is the down payment and closing cost assistance, and you can borrow up to 7% in some cases from them. That is that the interest rate on that is 2% higher than what your first is.
Okay.
So
And
it'd
about a
be so
10-year
today it'd
term.
be 15-year term.
Oh, 15.
Yep.
Okay.
So it'd be 775 on a 15-year term. But the payments I usually see range between 120 and 180 dollars a month that gets added to your monthly payment.
So if you're a home buyer that says, man, I've got to come up with 3.5% and my closing cost and then my inspection and then my appraisal, I don't have that. We've already talked about, not even a third of the way through our tools here, are you've asked the seller to help you with the closing cost. In our current market, there's a high degree of
Mhm.
likelihood you can get all of that or some of that.
Right.
Um, with down payment assistance, you can basically come up with, like you said, as little as like $500, kind of an
Yeah.
all in. Yes, you're going to have those two mortgage payments, but oh, and then by the way, we've already talked about with our promotion, we're going to cover the majority of the appraisal and the inspection fee. So really, your out of pocket is very minimal.
Correct. Yeah. And it gives you options, right? Which
Mm,
is what I love the best. It's not like 2008 where you don't have to put any money down. You're still responsible, right? So you still have skin in the game. Even if you're only putting $500 down, you're still responsible for that second lien. It isn't just, like we aren't just doing 100% loans to everybody, right? So,
right.
so it's not the wild, wild west like it was before '08. But so take a first time home buyer that doesn't have a ton of reserves and they have to put everything into their house, and they're buying a house that's resold, and now they get moved in and they don't really know what the expenses are of owning a house right
Right.
yet. And
Right.
they have some things to fix, or they need furniture, they need whatever, right? So depending on the situation, it gives you options to where, hey, I don't have to use up all my reserves. Well, I can borrow this for now. If we get in and 6 months, a year down the road, I decide I don't need that second, because we're good, we're taken care of, you can pay it off then,
Yeah.
right? So it's it can be used as a safety plug too, to be able to keep reserves. First time home buyers, like there's a lot that goes into a home that in the maintenance and just owning one that you're not aware of yet. So
Yeah.
even if you're just using it as that safety plug, it can be a great tool.
Yeah. Nice. So let's chat about rate buy down. Again, this can be from help from a seller, or it can be help or your contributions to buy down the rate, specifically in the context of the perception of high interest rates. So,
Hmm.
you know, I want to, I'm going to let you describe how this works, but what I want folks to know is there is a perception of high interest rates because we've come out of extremely low interest rates in the last couple of
Right.
years. But if you look at the historical average, we're right there. Actually, we're below that. So interest rates aren't high, but for those that want to bring them down, uh, I'll let you describe how the rate buy down can benefit them.
Yeah, I'll try not to get sidetracked into the high rate conversation. Yes, we're in and we are in an environment where they've been higher than they've been in a really long time, right? We hit 8% there for a while, and have been pretty, been in the sevens and sixes quite a bit. So, um, the rate buy down, there's a couple different ways that you can approach it depending on how high the rates are, right, and how long, just the economic market and the interest rate market, and how long we think they're going to stay up or whatever, right? So what we've used a lot over the last couple of years is a temporary buy down, which with, you know take a 2-1 buy down with not a giant chunk of money, right? Because there's something in, and it gets complicated, but there's something in, um, interest rates, the pricing sheets that we have on our side, that's called compression, and depending on where the markets are, there can be a lot of compression or no compression, and that affects how easily basically it is to buy your interest rate down, or how much money it takes to buy it down. And so, do you want to say something?
Yeah, real quick, I want to make sure that for our audience, and I appreciate your in-depth, kind of detail in the numbers, but also for folks that really want to are just now getting into home buying, is it oversimplification or is it too dumbed down to say basically you're taking money, whether or not it's your money or the seller's money, and giving it to the lender up front to buy down your rate, whether it's a permanent full term buy down or a temporary that adjusts? Is that an oversimplification?
No, it's not an oversimplification. There's just a lot that goes into it behind, right? So yes, you're right. To simplify it, that's basically what it is. So whether it's your money or a seller credit, you're giving, you're using that to buy the rate down, and then the two types of rate buy down, right, are determined by market conditions, how far we can buy it down, and all that stuff. So yeah, sorry if I was getting into the weeds there. It's just, it's hard to understand the difference and
Right.
when. And I guess that's again why you work with an expert that's going to coach you through all that stuff. Um, but in the recent years, because rates have been higher, and it hasn't been easy to buy it down a long ways, the temporary buy down has been great. So with a 2-1 buy down, you use a smaller amount of money, whether it's yours as a seller credit or a seller credit, and you buy it down 2 points for the first year, 1 point for the second year, and then the third year it floats back up to where it was when it's locked, in hopes that the interest rates would be lower in that amount of time, right? Permanent buy down, which we're in that realm now because rates have come down so much, it's easier to buy it down permanently into, now that we're right in the high fives with most,
Yeah.
some lower than that, right? But situationally, depending on the program, um, we're in the fives. So now it's you can you know it's more feasible for a permanent buy down. That means, you can use your money or a seller credit to buy it down permanently, and don't have to worry about it.
So is it fair to say, I just real quick, I want to just get a little more detail on the permanent versus the temporary, so folks know kind of how that works. In a permanent, let's just use round numbers of six because we're kind of there, which is amazing. If you buy it down to 5.5, whatever the term of your loan is, that's the permanent, right? Just like it sounds, it's
Correct.
5.5, which is a great permanent kind of long-term interest rate. Somebody can feel good about holding onto their home, and maybe over the years, if it got a point below that, or point and a half, that might
Right.
justify a refi. But you could go in at 5.5 and probably let it ride and feel pretty good about it.
Yep.
The temporary. Does it kind of simulate an adjustable rate? Because I think that's what people are going to kind of hear, the 2-1, 3-1, where the first year your mortgage is bought down 2 points to keep your mortgage at a minimum, and then the following year it's going to jump because your interest rate's going to come up, and then anyway, go
Yeah,
ahead and
it
describe
it
that.
it does, right? Like it gives you relief, right? There's a 2-1, there's a 3-2-1, a 2-1, or a 1-1, right? So it gives you relief over a certain amount of time. There's the difference is there's no balloon payment. There's no, it just floats up to whatever that rate was. So if it's 6 now, it just by the end of that temporary term, it floats up to 6%,
Yeah,
right,
and
or
you've got to
whatever rate
qualify
it is.
for the maximum rate, but you're getting some relief. So that would help
Correct.
folks and say, we've got a single income family, but my husband is, kind of fast tracking, within his
Yeah.
company, either on pay raises or promotions or both. So in a couple of years, we could feel pretty good about. I mean, one, we've already qualified for this number, so I can afford it today. But certainly in 2 or 3 years from now, as my income goes up, I can feel comfortable.
Yeah, and we're in a and not yeah. I guess I don't really want to get into market conditions, dude. We're just talking about tools, so I could go on forever.
Yeah, we can dig into these deeper as our audience shows some more interest in it. But let's chat a little bit about ranking these. So once we get off this first page, before we get off this first page here, and I know this is going to be tough to do because there's going to be so many nuances to it and so much personal kind of consideration about how these apply. But if you look at the kind of the average buyer going to buy a home from a scale of 1 to 10, if a buyer goes to their agent or lender and says, "Hey, I really want to know more about this," right? If we're only going to rank it a 1 or 2, don't spend a lot of time kind of chatting about it. Go talk about the 8, 9s, or 10s. So let's
Hmm.
kind of quickly go through this seller concession. Kind of what's your thoughts on a 1 to 10 scale?
Well, when they're around as heavy as they have been, it's top three easy. You know what I
Yeah,
mean? Like it
yeah,
really. But the problem is you can't depend on it, right? And
right.
that's what makes it harder to keep it in that top five.
Yeah,
Um, but when like for the last year or two, it's it's 1 or 2 in my book, as far as you know what I mean, as
yeah.
far as uh, benefit to the buyer.
Yeah. Yeah. So not only is it around, but how aggressive can you be? Right. If I get a
Yeah,
seller concession of, you know what, man, as a seller, I'll throw you 5 grand to help you out. Not super helpful.
right.
But when we're in a more buyer friendly market and you're asking 10, 15, 20, $25,000. And by the
If
way, I can ask for my rate buy down. I can ask for, you know, the yard or whatever. Yeah, I agree with you. When they're around, I would say it's in the top three. And then as the market shifts towards a seller's market, it's just going to drop
Yeah, just
accordingly.
prior to this, right? You know, the COVID years or whatever, it didn't exist, so it wouldn't even be in your top 10.
Right, right, right. I think that's a good kind of summary and rating. The I think I kind of know where we're going with this one, but the no down. What's your ranking on that one?
Um, so that's very situational
That's where
for
I was
me
thinking.
as
Yeah,
as a lender, right? So the problem, like I love it for our veterans that are moving every 4 years, right? Gives them ability to own a home, possibly build a little bit of equity, but basically have that place for their family, right?
yep, yeah,
Um, I don't like 100%. I typically don't like 100% down loans because they're slow to build equity, right? Like,
yeah,
and you typically have a higher payment, even though it's a government, it's a government loan. Interest rates are usually good.
yeah.
Um, I see it as a tool if we don't have another better financial option.
Gotcha. So maybe could we break it down into for the right person? It's a great tool.
Correct. Right person, right situation.
It's way high, but
Yep.
if you're just looking to get into a home on by the skin of your teeth, and you're going to move sooner than later, you know, it's not it's a good tool, but not super helpful for your
Yeah.
financial well-being.
Yeah. Yeah. Because you have higher mortgage insurance, and then you've got an upfront premium that goes into that adds to your cash to close, right? Your closing costs.
Yeah. So rated high if it's the right buyer. Rated actually low if you're just using the tool in an inappropriate way.
Yes, correct.
Yeah.
Yeah, I mean when you and again it depends on the state, right? Like we're so blessed here because I can switch you to two or three other products that are great for you with only 500 down. What's the difference between 100% and $500 down, right?
Yeah. You don't have
So
those other negative trade-offs.
right,
Yeah. Yeah. Absolutely. Down payment assistance. I got a pretty good idea where this one's going to land.
yeah, that's yeah, for me that's in Idaho especially. That's number one.
Yeah.
That's my number one. I really like that tool. It's around all the time. The rules change, right? There's programs that come and go. The amounts change, but all they've done over the past 5 years is get better. They've become a better partner for us, for all their lenders in the valley, and they're great to work with. They also, and I sound like a commercial for Idaho Housing, but they also service their own loans, which is something that I, as a lender, that I love, right? Because they service it for the lifetime. So you close with them, you know who your servicer is. Whereas, you know, a lot of servicers sell and buy and stuff all the time, so your loan can move around a bit.
Yeah. Yeah. Um, not as much as the 100%, but there are some buyers that I think could inappropriately use this and get themselves kind of jammed up. Not nearly as many. Um, so I would say for most people, really good. For others that aren't really thinking out their financial future, I think they could jam themselves up.
Yeah, I mean, you don't need to unnecessarily add to your monthly mortgage payment.
Right.
If
There you go.
like if you don't need it, if you're just doing it to do it, then why, right? Like the more equity that you can build faster, so if you have the down payment and you can cover that without taking it from investments where it's going to hurt you financially or whatever, right? So adding to your monthly payment for no reason just doesn't make sense.
Yeah, that's another good one for buyers to know is where else could that money be better used? Do you just kind of need that reserve sitting there so that it's liquid?
Yeah,
Or do you have some investment strategies that are going to yield a better return? Those might
right.
be reasons why you would do that. So,
Hmm.
very very high for most on that. Certainly in Idaho.
Yeah,
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 absolutely. Not a whole lot of negative. Like you said, most of the time you're going to get dinged on the rate side of things. I mean, I hate to call it a convenience fee, for but lack of a better word. You're paying that extra, but for those that, especially for those that are super aggressive and paying off that second, because it is a higher interest rate and just being done with it, and then seeing that
yeah. And
equity.
there's no prepayment penalty for paying it off early. There's no, you know what I mean? Like it's definitely positive. We don't ever like to put people in the position where they're house poor. But one of the biggest problems, with the cost of living and where pricing has been is savings. Not they can make a payment, right? They're making it in rent,
Yeah, yeah,
but it's not allowing them to save up, right, for
yeah,
that down payment.
yeah, absolutely. Um, Interest rate buy down. We have not ranked this. It's just so everybody knows our podcast this morning is earlier than usual. So yeah,
Um, it's so, and again, I'll put this with seller concessions, okay,
yeah,
because it is a moving target as well. The temporary buy downs have been key, right, of the last 2 to 3 years. Like
yeah,
they've been a huge tool that we've been able to use for benefit. Permanent buy downs, can be good. So once you get under 6%, so my explanation is going to be a little bit long here, but there's purpose behind it. So before all the nonsense, right? You go back to 1819. Where interest rates were about. I remember when they broke under 5%, we thought it was Disneyland, right? So 4.5 to 5.5 is fantastic. Into 4.5 is low. Okay, so when we're in 6, and typically when you refinance, you don't want to refinance unless you get a full percent, right? That's kind of the baseline that we'll go by to make the cost of the refinance worth doing it.
That's a rule of
Okay.
thumb that we can
Yeah,
generally say.
everybody's situation is different, but that's a general rule of
Yeah.
thumb,
If you're
right?
at 6, until it gets under 5, the cost benefit analysis just doesn't compute,
Correct.
generally
Correct. Yeah.
speaking.
Generally speaking. Yeah. And so when you get down to, you know, 6 or 5.5, right? Like the temporaries kind of don't make sense, right? Can you do a permanent buy down and get yourself to 5.5 or 5.25? Because that's more of a long-term rate, right? The chances of you needing to refi over the next 5 years because rates drop to 3%, which I hate to say to everybody, like
Good
they
luck.
shouldn't have been there in the first place. If we get there
Right.
again, I think the economic damage might be irreparable, but it's
Right.
not something we want to see.
Yeah.
It's just not.
Yeah. If we're
As
at 3s, we
consumers,
got
it
other
is.
problems pretty confidently.
Yeah, yeah. As consumers, we want to see it, but it's not healthy. It's not realistic, and
Right.
so
We're there
um,
to offset some major kind of issue.
right, right. So for me, the temporary stuff is kind of going away, because at 6% over, if you do a 2-1 buy down, is it really going to be at 5% over the next 2 years?
Right.
I don't know, right?
Right.
So if you can do a permanent buy down and get yourself, I think those are more prevalent. So I'd probably put that at the maybe number 5, 6, right in there. I think
Okay.
it's important.
Yep.
Um, now, like it, because it might be able to get you into a situation where you don't have to refi over the next decade.
Yeah, depending on timing, it can go up really high, and other times it can
Yep.
kind of go low because the benefit of the monies that you're putting towards that are yielding a different, financial kind of benefit number.
Right.
So
Right.
yeah, that's tough. And hate to be kind of vague on these, but it's just going to be kind of situational and also based upon where we're in the market. Anyway,
Yeah. Yeah. I'm solid on my number one.
you're still what?
I said I'm solid on my number one.
Yeah, gotcha. Gotcha. Well, so here's what I'm thinking, Chase. We're half an hour in and we're not even halfway done. So we're going to have to make this a part 2 for sure. Um, let's just do 2 more and then wrap it up for today. And then
Yeah.
we'll create another episode. Does that work for you?
Works for me.
Okay. So let's talk about general price reduction. Obviously, that's kind of everybody's go-to. Hey, it's a $500,000 house. I would absolutely love for it to be a 480, 470 priced home, which that's easy math, right? It's a $20,000, $30,000 off kind of if appraised at that $500,000 value, you got a $30,000 equity at 470. Um, which is always that point of negotiation that you can make. But how would you rate it compared to some of the other options we just mentioned? Meaning, if I was going to throw, 10 or 15,000 at an interest rate buy down versus a price reduction, that's a calculation that you need to make, and it isn't always clear.
Yeah. So again, like specifically on a purchase, if your option is price reduction or interest rate buy down, right? Like I like whatever. Let's see how vague I can be. I like whatever gives you the lower monthly payment. Like so, that's the thing, right? You're maybe going to change your payment $50 for every 10,000 in reduction on price, right? So it's not a huge savings monthly.
Yeah,
Whereas if you can reduce your interest rate half to 3/4 of a point, um, it can save you tens of thousands over the life of the loan,
right,
right?
right.
So I do like that, but again, so like assuming the person's gonna stay in their home for a long time, assuming normal markets and appreciation and everything, then I'd probably lean towards interest rate reduction versus a price reduction. I think because I think if you can, it also gives you that ability to, instead of reducing the price, maybe they'll give me a seller credit, right? Like that flexibility there. It gives you 2 or 3 options, I think.
Yeah, I think, everybody loves to buy at the lowest. And if you're going in, buying it for the full term and you got that 30,000 and you already got a good interest rate, I think it's a great tool. But I think it's usually the knee jerk tool is that I want to buy it cheaper, and that is not always the preferred way to go, right? Because if you can knock off of a 0.5% or a full point off your interest rate, depending on how much the seller is willing to throw at it, which by the way is probably less than what you're asking for in the way of a price reduction. So there's a higher degree of likelihood of getting that accepted. But now to your point, your mortgage payment is reduced over the term. So the longer you're in it, the longer it'll matter, right? My monthly mortgage payment is minimized for 10, 20, maybe 30 years. But when you look at the full term of that loan and the reduction of that interest rate, you've saved way more than the 20 or 30 grand you asked off of the price.
Right. Right. And you like if you dive into that deeper, right? If you look at your financial, well-being, right? If you take that money that you would have been spending and now you can invest that because your payments lower, you're saving interest cost over the right, and multiplying that, your home's always going to appreciate.
Yeah.
It just is that you can almost count on 3 to 4% across the nation year over year at a minimum. In
Yeah.
Idaho, we've been much luckier than that. Very, very seldom does it go down. So as long as you're not overpaying for the house,
Yeah.
right, where you're starting off in a hole, which we did see COVID, right? We saw that quite a bit. But
Yeah.
if you're not in starting off in a hole, what can we do to save your monthly costs, right? Because that allows you to now maybe invest some money or really, really multiply that. Because again, your house will always appreciate.
Yeah. So a good tool, not the highest, but depending on what other tools you can deploy to benefit you, that might be a preferred avenue or way to go. Anyway, everything comes with a nuance, but it's a good tool, but there could likely be something better, especially in today's market.
Mhm.
Yeah. Okay. Cool. Well, I think so. We're halfway done. Let's just try to divide them up. We've ranked them all. Let's just divide part one and part two equal five parts. A couple more tools came to mind. Maybe I'll add them to part two
Yeah.
and end up with a few more. But what's your thoughts on kind of this ranking here after going through it? Do you
But
feel like anything you would adjust?
no, I mean, I will once I see the rest of them, right? But we're gonna have to come up with it. We're gonna have to put them 1 through 10, right? So, um, man, yeah, we're gonna have to put them 1 through 10. And so that's at the end, yeah, I'll have to dial myself in a little bit here. I think I'm pretty good, right? Like there's a
Yeah.
couple there at the end that I really use a ton that have been just phenomenal tools. Um, yeah,
Okay.
I think we're good. I think we're good.
Awesome.
I
All
think
right.
I think I have my top five built out anyway.
Awesome. Well, very good. Well, as always, Chase, we really appreciate you coming on and chatting through from the lender perspective, kind of giving advice and informing, educating our listeners and our watchers. So we appreciate your time.
Absolutely. Always enjoy it.
All right. Otherwise, everybody, we'll wish you a blessed one. Take care.